Hello, good evening, everyone, and welcome to another series of our monthly webinar on equity market insights, where our experts talk about the global and domestic markets and their perspectives and insights on the outlook. And we also deep dive into one of our fund's strategies. As you all are aware, US administration's tariff announcement has heightened the market volatility. And as an investor, it becomes challenging to understand how to sail through this phase. I'm Sonal Mittal, product specialist at UTI, and I'm joined by our CIO, Mr. Vetri Subramaniam, who will take us through the market updates and how investors can navigate this volatility. And I also have with me fund manager, Ms. Preeti, who will take us through the strategy of UTI Banking Financial and Services Fund. Before I hand over to Vetri, let me remind you that you can post your questions anytime during the webinar on the link provided. Without further ado, I will now hand over to Vetri. Thank you.
Good evening, everybody. Thank you for joining us here on this edition of the Equity Market Insight, the first of the new financial year. It's been a very interesting financial year, March 2025. Full of a lot of news, full of developments. But I would say that is true of pretty much every year in the markets. There's always something new happening in the markets, and that's literally the nature of the beast. But we have a lot to cover today. And of course, I'm also joined by my colleague, Preeti RS, who's started her career with UTI and is in her 14th year at UTI and is now successfully managing our banking and financial services fund. And she'll be covering that fund in more detail after the first section. So let's jump in and we'll first, start to cover some of the macro. So we are all aware that the US has decided to hike tariffs significantly. Not only have they put in an across-the-board tariff of 10% on all countries, but they've also imposed what they now call reciprocal tariffs. And on the left-hand side, you can see the impact of these tariffs, which literally raised the tariffs back to a level which was last witnessed only at the beginning of the 20th century. So it's almost like 100 years of globalization, of unfettered movement of goods across borders, of global supply chains, which is now being re-evaluated by this US move to move tariffs up so aggressively. Very quickly on the right-hand side, who is at risk from not only this across-the-board tariff, but also the reciprocal tariffs. Unfortunately, the burden disproportionately falls on many smaller countries, which are very big exporters to the US. But because the size of their GDP is much more limited, they do not really import too much from them. So you look at this chart on the right side, Singapore, Vietnam, Malaysia, Taiwan, Thailand, Korea. These are the countries which actually have very significant exports to, the US. And of course, the second largest would be to China. When you look at it in the case of India, our exports to the US are merely about 2% of GDP. So in that sense, our exports of goods, I should clarify, this is goods exports, our exports to, the US are merely 2%. If you look at some of the other countries and add up the total exports that they are making, then in some of the smaller countries like, let's say, Vietnam and Malaysia, this adds up to almost 70-80% of their GDP. And therefore, this kind of a disruption to global trade can really hurt some of the small exporter nations a lot more significantly. So clearly, this US tariff war that they have now begun on. They believe this is something that they are being forced to do because the world has traded unfairly with them, both through tariff and non-tariff barriers. But this is really now a significant disruption, which has literally reverted tariffs back to where we were 100 years ago. Moving on from this slide, what does this really mean for equity markets? That is really the most critical question that most probably everybody has on their mind. I think the very simple textbook answer to this is that when there is heightened uncertainty, consumers postpone taking decisions on consumption, particularly large ticket consumption. They postpone taking decisions on risk, on borrowing, on investing. And simultaneously, businesses also start to pull back because, if your supply chain is going to get disrupted by these tariffs, then you have to think about putting new capex on the ground. How will you sort of make sure that that new capex will be able to overcome the risk posed by these higher tariffs? So higher uncertainty causes economic constituents to put a hold on decision making. That creates doubts in terms of growth. In a mathematical sense, rising uncertainty is nothing but a higher risk premium, and a higher risk premium is nothing but a lower PE multiple. The challenge for the markets on a normalized PE ratio is that we have just about started our descent from a very elevated PE ratio level, and therefore from that point of view, even though this isn't updated for the fall of the last 2 or 3 days, we are still above that average line, or maybe just about coming near that. So yes, there has been a significant correction in the market. I'm not going to underplay that, but really we are just normalizing back closer to the averages. We are not yet at the average, and the uncertainty converts into higher risk premium. And this risk premium is not only because concern about near-term growth, it's also about how long the uncertainty might persist. And therefore, this sort of affects your view of earnings that the company might be able to earn, not just in the next 3 months or 6 months, but also the next 12 months and 24 months. And therefore, it's very hard to figure out the impact on earnings. But the simple way to solve for that is to reduce the PE multiple that you're willing to pay for the company. Moving on from this to the next slide, I think one of the direct impacts that one can expect from whatever the US is doing is that this certainly heightens the risk of a recession in the United States. Why do we say that? From the point of view of the United States, this increase in tariffs will certainly have an impact on decision making. And remember, simultaneously, the US is also trying to reduce its fiscal deficit, and the chosen method for them to do this is through DOGE, to try and cut expenditure. And the tariffs are nothing but effectively a consumption tax, irrespective of what people might say. It is a tax that effectively the consumer has to bear. It is unlikely that the entire burden will be picked up by the supplier. We can discuss how much by the supplier, how much by the buyer, but some part by the buyer. And therefore, effectively, it means higher tax revenue for government, and that has a contractionary impact on the US economy, and which is why increasingly the concern is that we might be headed into a recession in the US. When there is a recession in the US, this impacts growth across the entire world. And of course, the entire growth also suffers from that, pall of uncertainty, which is now emerging from the US. And when you look at Indian growth, we have slowed down during periods of a US recession. Very rare for us to have gone into negative territory. One of the few times it happened was, during the GFC period, where growth in India, which is the blue line, went negative. But if you look at the blue line in previous instances of US recessions, those are the pink bars. So the pink bars are when US GDP went negative and there was a recession. What you will notice is that the blue bar rarely goes into negative. But of course, from an equity market point of view, the concern is not that India will go into recession. As I said earlier, our exposure, total exports to GDP, when you look at about $450 billion of exports, GDP of almost $4 trillion. So that's about 11-12% of GDP. That will really not cause us to go into a recession. But remember, the equity market till about 6 months ago was priced for very high growth, and we already know recent growth has been disappointing. This kind of uncertainty can only cause GDP growth estimates to go lower, and that therefore creates a bigger issue for PE multiples. But from a growth perspective, we don't expect India's growth to turn negative because our exposure in terms of goods exports is limited, and exposure to the US is even more limited at just 2%. Moving on to the next slide. What is changing in India particularly over the last 2 months, has been the thought process on liquidity. We have a new RBI governor. Today, the MPC announced a 25 basis point rate cut. They also talked about, changing their stance to accommodative. But even ahead of that, if you look at the left-hand side, what you can see is that the interventions that have been done by the RBI have caused durable liquidity, which is that red line, to actually, and remember, this red line had actually gone into negative territory in December, Jan, Feb, but it has now pulled back into positive territory. There is more that it can go up. I would not look at the numbers in 2021 as a benchmark, because remember, at that point of time, it was the post-COVID environment where monetary policy was very loose, but there is still certainly scope for durable liquidity to go up. That is something the governor talked about today. And I think an increase in durable liquidity will certainly help the banking system and interest rates in general. On the right hand side, you can see lending and deposit rates. The deposit rates have continued to move up while lending rates have tended to come down. But I think this is more a temporal issue. As interbank liquidity starts to improve, I think you will eventually see some cool off in the deposit rates as well. Moving on from this to the next slide. We already talked about the fact that in India, even though the impact on GDP growth is limited, and I talked about this last month as well when we did the equity market insight, a 13-14% earnings growth CAGR over 2 years is not a low bar. It is not a very high bar, but neither is it a low bar. Why do I say that? Nominal GDP growth in India is now running at about 9.5 to 10% for the last 2 years. And given the construct of GDP growth and inflation that monetary and fiscal authorities are comfortable with, this would convert into nominal GDP growth rate around the 10 to 12%. To be able to get 14% earnings CAGR out of 12%, nominal GDP growth when margins are already elevated over the last 3 years, I think will be difficult. So the earnings growth expectations are high, and they are high relative to the rest of the world. And of course, that is one reason why India's valuations as well relative to the rest of the world are a little bit of a high. But we'll see later, India's valuations on a composite basis relative to history have actually now come back into the fair value zone, but more on that later. We'll jump through now, to the regular set of slides that we cover. The next slide just talks about market performance. If we were looking at this slide 6 months ago, just look at that extreme right side 1 year performance. If 1 year ago we were talking about this slide, there was massive outperformance by the mid caps and small caps compared to the Nifty 50. Today, that gap is completely gone. You have the Nifty 50 1 year performance at 5%, small cap at 5%, and Nifty mid cap slightly better at about 7.5%. But that big gap is completely gone. I'm also heartened to see when you look at the 1 year sectoral performance on the right hand side. For almost a year, we have been saying that the only sector in which we actually have great bottom-up comfort in terms of valuations and the positioning on the risk-reward curve in terms of the valuations, the strength of the balance sheets, and the outlook for the future, we kept saying that the banks and financial services is where we have maximum comfort. And it's very good to see that now on the right-hand side, financial services and the bank indices are now leading the way in terms of outperformance on a 1 year basis. And some of the favorites of 1 year ago have actually given away a lot of ground. The financial services and banking area are not only outperforming the Nifty, they're also significantly outperforming the mid-cap and small-cap areas, which was not the case even, I would say, going back to May, June of 2024. Quickly jumping through, I won't spend too much time on this slide. We've already talked about this. The source is slightly different, which is why you see 12 and 13% earnings CAGR. This is Bloomberg consensus for March 26 and 27 compares to the 14% number you saw on the previous slide. That's just a difference in the source. But fair to say, this 12 and 13% in line, slightly above what I think is likely to be the nominal GDP growth outlook for the next 2 years. And that, poses risk. And remember, this is even before analysts start to factor in any positive or negative impact of what's happening on tariffs. And if you expect tariffs to suppress global GDP growth, it's a little bit hard for me to see how there can be a significant upside. The main thing to remember is that the earnings impact will be very idiosyncratic, which is to say there could be some companies which will take big haircuts on earnings because of whatever is happening in terms of tariffs and uncertainty. But there could be some companies which also end up becoming beneficiaries, because remember, the increase on tariffs in India is limited compared to some other geographies, and therefore there could be some benefits which flow to certain industries and companies. Hard to figure out at this point of time what they are, because there's still many moving parts. But I do think idiosyncratic changes will be very, very acute this time around as compared to the headline number, which is what you see here. Moving on to the valuation slide, I think this is really the good news. You look at the trailing P multiple, it's back at the average. This is as of a few days ago. You look at the right side, Nifty forward P multiple. So Nifty 50 valuations are basically large cap valuations. Left hand side, trailing price earnings at fair value at the average line. Even forward PE multiple in the white zone, which is fair value, though still above the average line, which is the yellow line. What does it look like on a price to book basis? That's on the next slide. Here again, markets were in the red zone, which was expensive, but it's come back now into fair value, slightly above the long-term average. So, valuations in large cap zone, certainly in the fair value zone, with some indicators giving more comfort than others. What does it look like in the mid cap space? What does it look like on the small cap space? Here's a chart on that. This is again the price to book. Honestly, the mid cap 150 on price to book still looking very much in the rich and expensive zone, which is why our comfort level in mid caps from a top down basis, and I'm talking top down, I'm not talking about, I'm sure later when Preeti speaks, she may talk to you about one or two mid caps she likes. Many of our other fund managers also have a few mid caps that they now like. But top down as an allocation decision, mid caps in aggregate still very, very expensive in our view. Small caps, the extent to which the valuations have worked off is significant. But if I were to just look at small caps relative to large caps, I still find the valuations excessive. So really, our preference would be large caps in fair value, mid caps and small caps. We still don't take comfort on a top-down basis. Jumping through to another interesting slide. I don't always show this, but this is a very interesting slide because this really is an inter-asset class valuation slide. We are looking at the valuation of equities and we are comparing it to the valuations of bonds. How do we value bonds? We are saying we are taking the 10-year yield of the India government bond, which is currently about 6.45, and we are comparing it to the yield of the Nifty 50. What is the yield of the Nifty 50? It is nothing but the inverse of the PE ratio, the forward PE ratio. So it's 100 divided by the forward PE ratio. And when you subtract these two numbers, that gap is now coming to minus 1.1%. What is the sort of long-term average for this number? It is about 1%. And if you look at the slide, what you will see is that for the last 2 years, this gap has been closer to minus 2%. So for the first time in 2 years, this number is now coming back to almost the average line. And therefore, it is very close to the zone where equities actually become favorable relative to fixed income. If you look at the returns in fixed income over 1 year, depending on the duration of the portfolio, fixed income has yielded you anywhere between 7% to 9.5% to 10% at a portfolio level. Compare this to what you've got in the earlier slides, Nifty 50 1-year basis delivering 5%, and then similar numbers for the others. So there's been a significant outperformance by bonds over equities over the last 1 year, and that sort of pulled this line back to closer to the baseline. Depending on whether you take a 10-year or 20-year average, it could look different, but I would say for the first time in almost 2 years, we are coming back to almost that average line, and that is quite remarkable. When we put all the valuations together, you can see the impact of this on the next slide. This shows you our combined equity valuation index. It puts together PE ratios, price to book, dividend yield, and finally the comparison of equities to bonds. When you put all of that together, when this index is in the top red or orange zone, it is an area to decrease asset allocation. The middle yellow zone is the fair value for equity investing. Interestingly, this combined indicator has actually come into the light green zone, which is actually a zone which is favorable for increasing equity allocation. So this is a remarkable change which has happened in the period of just about 8 months to a year, where we've gone from decreased equity allocation to a zone where we can now look to increase equity allocation. Interestingly, our multi-asset allocation fund and balanced advantage fund, which actually rely on this indicator for their allocation. If you go back to September, October 24, you will find that their equity allocations were closer to 45%. With the current fall in the market, our equity allocations have gone up to almost 60 to 63%. And I think any further fall in the market, you will see these allocations go up perhaps further. But the point to be made is that the reason this is happening is this composite valuation indicator is now in the increased equity allocation zone. So this is the final slide, conclusion side. This is just a slide to sort of capture to you what is the implication of being in the increased equity allocation zone. So there are multiple, sort of columns, so to speak, over here. Just look at the one which is titled 14%. Any investor who invested when the market was trading in the green zone, their average 1-year return has been 14%. The maximum return has been 52%. The worst return has been 21%. 57% of the time investing when the market is in the green zone, your return has been higher than 12%. 6% of the time, of course, there was a risk that even though the market had dropped into that green zone, and this is reflective of the Nifty, you still ended up with a negative 1-year return. But this is certainly a favorable zone for raising equity allocation, and that is the message. Of course, when the market moves into the deep, dark green zone, the odds improve even further. But right now, we are in that fair value zone. And when you think about a 12% threshold level for equity returns, we have dropped to that region where now the probabilities are favorable. Final slide, which is a summation of everything that I've talked about. The US tariff hike leading to a trade shock likely to impact global GDP growth in the current year, and it adds to uncertainty, decision making by companies, by every economic participant, and is likely to have a negative impact on GDP growth. India's exports to the US are just 2% of GDP, but there will be second order impacts which will have a bearing on growth. Main point I would make is that, remember, second order impacts can both be positive and negative. So for example, if there is a manufacturer in India competing with a Chinese company, if the Chinese company's tariff is 104%, India's tariff is only 26%, suddenly there is a big margin which you will be able to exploit, presuming you have the capacity, the ability to respond, to produce the product that the customer in the US wants. So there will be both positive and negative impacts, some which companies may be able to overcome, some they will not. But, which is why I want to reiterate the point that it's a combination of positive and negative, not only negative. The rupee has appreciated against the US dollar in the last 2 months, which has reduced some of the pressure on RBI. Maybe that is what has also allowed them to be more accommodative. Crude oil has gone through a dramatic collapse, which is good from India's perspective in terms of trade balance and also in terms of inflation. We've talked about liquidity boosting by RBI and the reduction in the repo rate. Consensus earnings growth 13% for 26. I just want to highlight uncertainty is high. The top line number, the headline number may have some volatility, but more than that, I expect significant company level volatility unless there are companies who are completely linked only to the domestic market, where volatility or risk to their earnings estimates might be low. But remember, their earnings growth per se was anyway not great to start with. We still continue to like the entire series of hybrid strategies. They can be considered for lump sum investments based on your risk appetite, everything from the aggressive hybrid to the more dynamically managed, balanced and multi-asset allocation, which will raise or decrease asset asset allocation to equity is based on our proprietary equity valuation index, and for more conservative investors, the equity savings fund. The reason these funds look attractive is that it combines the ability to manage volatility and valuations along with what we believe is a very positive carry that exists in fixed income markets today. Remember, today RBI talked about a 4% inflation for 2026, and we still have high quality bond portfolios yielding slightly in the region of around 7%. That's a good positive carry for bond investors. Last year, after 4 years, we have seen quality growth sort of match value in terms of full year performance. And some of this was because in March actually of 2024, value did very well relative to quality growth. But I think the trend reversal is now visible that for 3 years, you had strong value outperformance of quality growth. Last year, both was sort of equal. And I think the advantage now is in the quality growth bucket. We think investors should be willing to dip their toes in the market, if not both feet, which is why we continue to recommend a staggered approach. Valuation, we are more comfortable with large caps. That doesn't mean only large cap oriented strategies. We just mean strategies which have more allocation towards large caps. That is where our comfort is because large cap valuations are in the fair value zone. So that's sort of a wrap of the macro. I'll halt over here and hand over to Preeti, who's going to talk about the UTI Banking and Financial Services Fund, which she's been managing for a few years now. And of course, she's been an analyst tracking the sector. So she has a rich amount of experience tracking this sector. Over to you, Preeti.
Right. Thank you, Vetri. Thank you for setting the tone for today's market insight session. And if the audience has been keeping a tab, so Vetri has been bullish, particularly bullish on the BFSI sector over the last 1 year, and it has been proven right. And today I take this as an opportunity to take the audience through this, through this presentation. What are our views on the sector and what we're thinking going forward as well. So, first slide, this it's a broad overview of the sector and specifically the sub-segments of the sector from a very longer term point of view. So banks are typically the poster boy of the sector. So we wanted to highlight, the sub-segments as well, how they have done over the last 10-year period or over a decade. So clearly you can see that if you see the bank's growth on the right-hand side, so it's 10% growth, I think mimicking the nominal GDP growth, but then everything else is on the left, significantly outperforming this growth. So private banks itself have outperformed at 18% growth, whereas public sector banks, went through a bit of crisis in the second half of the last decade. But we've seen them as well come back now. And I think the one sector which stands out is the capital market linked sectors like the equity AUM demat account. So clearly, since the pandemic, we have seen significant growth in demat accounts, and also the SIP growth has been quite strong and holding up. So that has pretty much trickled down to some of the sectors which directly benefit from these structural drivers, and then there is life insurance, which is also growing at 14 to 15%. So moving on to the next slide. But if you see specifically on lending and insurance, I wanted to highlight that over a very long period, over like two to 3 decades, like the insurance opened up in 2000 and private bank sector. So it started flourishing since 1995. So since then, these sectors, in addition to the penetration driver, so they've also benefited from gaining market share from the public sector as well. So today, on the right-hand side, as you see, the bank loans and deposit share, so it's at 40% is by private. So they have continued to gain, and whereas on the insurance side, it's 2/3. So 2/3 of the market is now with private. So they have those twin drivers which they have benefited from. So moving on in the third slide. So here, if you see, the first slide talks about the credit growth. The first bar, the 2 bars, as you can see, the public sector growth was quite anemic at 2.5% for over 6 years up till FY21, while private sector banks continue to do well at 16%. So this was because of the AQR crisis and some of the prompt corrective actions that the PSU banks went through and hence couldn't operate at optimal level. But if you see over the last 4 years, we have seen the PSUs make a comeback on growth. And in fact, this year we have seen that growth converge, right? We have seen the growth actually come off for the sector itself, and hence the gap between the private sector banks and public sector banks is quite minimal. But the important metric to follow and track is the deposit growth. If you see on the deposit growth, the gap still remains. It is still wide, like at even on a 9-month basis of FY25, it's like 400 bips. So clearly, the private banks continue to lead in the deposit mobilization, and that talks about the strength of the liability franchise, and also it's also a reflection of what can happen in future. So I think that's why our bullishness on private sector banks continues to be high. Uh, in the next we cover in the next slide, we cover, the topic which was very discussed, which was discussed a lot in the last year on the LDR. So if you see over a very long period, so they usually converge or they're very close to each other. The deposit growth on a 20-year basis is 14%, and loans growth is 16%. So this will definitely have an impact of the reduction in the statutory, liquidity ratios, SLRs, but if you see on a 10-year, 5-year basis as well, so pretty much the loans created, which should ideally create the deposits as well, and hence it will take care of the LDR as well. So I think that puts the LDR debate to rest. And I think the recent commentary that we have from the RBI as well, I think that's something which is now being taken care of. So taken care of, as in the next slide we would see that liquidity is also improving. We have seen this bouts of deficit over the last 1.5 years. I think this is a slide which Vetri also covered in his presentation, the durable liquidity part, where it was significantly higher during COVID times because of higher savings, and that was available. So, but now historically, it's been in the range of 1 to 2% of NDTL, and I think the RBI is focused on that, which I cover in the coming slide. In terms of the tailwinds of the sector, if we talk about, there has been regulatory easing, so RBI is quite focused on maintaining this positive or surplus liquidity, and I think that's something which they reiterated even in today's monetary policy note. And the second bit is a couple of things that have changed in the last 2 to 3 months is that there have been risk weight reduction on certain segments like microfinance and NBFC, and there were certain there were some changes that were also expected to hit the P&L of banks like LCR, ECL. So that is also, we expect the timelines have been extended. So I think that in terms of regulations for the banking as a sector, I think that have been easing. I think that's a positive, and the monetary easing, which we all are aware of today. So including the 25 bips rate cut at the last monetary policy day. So today the 50 bips rate cut are in place, and there's expectation of more cuts given the concerns of the slowing global growth due to higher tariffs. So that sets the stage, I think, for the banks as a segment. But we're making a pitch here. What is the case for investing in BFSI sector? So here we say that credit or the loans is the key propellant, or the backbone of the economic growth as we march towards to being the third largest economy in the world. And then and historically credit has grown at like 1.4x GDP. So it is a growth sector, and hence an outperforming growth sector compared to the nominal GDP with a decent visibility. And of course there is this kind of penetration driver as well. So the lenders are key beneficiaries of that, as our credit penetration is still much lower at less than 40% to GDP in terms of retail, and the hope of corporate recovery continues to keep us excited on this space. And in terms of the health of banks and their balance sheet, so I think they're the best in the decade. They're reporting one of the best ROAs, and as well as they're flush with capital to support the growth that's expected to come from the retail, corporate, and as well as the SMEs. And specifically investing in a BFSI sector fund will give the investors the opportunity to participate beyond lending. So the financialization of savings is a mega trend. So which will get captured through some of the opportunities like the AMC companies, stock market brokers, or exchanges. So the sector fund will be able to capitalize on some of these opportunities, and hence it's a way to get exposure to this mega trend. The third most important in the given scenario, and I think it's been playing out over the last 1.5 years, is the sector valuations have been quite comfortable. So it's in fact it's at below mean. I think they have a chart to show that despite improving return metrics, profitability metrics, and the health of the balance sheet itself. So that gives us a lot of comfort in terms of going overweight on this space. And going back in terms of the over like a 10-year, sorry, over 20-year plus period, so Nifty or the BFSI sector, Nifty Financial Services, has outperformed the Nifty 50 index by 300 pips. So so this is the part that I explained, how BFSI sector fund like us will give us exposure beyond lending, which will also which gets us exposure to insurance, capital markets, and fintech. And the next slide covers, yeah. This financialization of savings is a mega trend. So I think there are three charts here. So the left-hand side chart, so you can see the demat account growth has been pretty strong. So if you see, the growth has been upwards of 30% or consecutively for the last 4 years, versus less than 15% for almost 6-7 years. So that's given a lot of ammunition, or it has given a fillip to the sector to capitalize on the people who have come into the sector over the next decade, as they get familiar with investments, and also increase their exposure to equities per se. And then the second chart on the SIP on the bottom chart. So as you can see, the SIP growth has also been quite strong. So it has grown at a 33% CAGR over the last 5 years. So it's a phenomenal growth that we have seen, and continues to be strong even in the turbulent times that we've seen in the market over the last 2-3 months. And the chart above is where we are in terms of the equities as a percentage of household assets. So it's still at 7%. So compared to, I think, some of the peer countries, which are anywhere between 20 to 50%. So we are just we are I think in the right path, and I think this exposure can definitely increase as exposure to other segments of the assets will go down. So then, and the next slide is on the insurance sector. I think this is the protection aspect. So as the GDP per capita increases, and the need for protection rises. So I think, be it in terms of life and also in terms of the property, auto, etc. I think this is a sector which will keep growing, and as customers become more aware. So here I think I spoke about how the private sector has gained at the cost of public sector. So today, over the last 12 years, we have seen that private covers almost 2/3 of the sector in both life and non-life insurance, and this is an interesting space which actually solves for a problem in terms of risk of mortality or morbidity, and of course any untoward instances in case of liabilities of property. So this is the last bit which covers on the valuation, the most important thesis, like when we see other sectors, and also keeping the earnings in context, and the certainty of the earnings in the context, given that this is a very domestic oriented sector. While it will have some ripple effects, given, of course, the global growth slowdown will have some ripple effect, but this is a sector where we still do have better certainty and visibility, and hence, since the valuations are also in our favor, gives us a lot of comfort. The left-hand chart talks about how the valuations are now closer to actually -1 standard deviation, and if you just split it between private banks and PSU banks, private banks are actually trading at a multi-year low valuations, and while PSU banks did re-rate significantly over the last 2-3 years, have also seen moderate but still very expensive. So this gives us a chance to actually be selective and pick our bets in both private sector and public sector banks. So this is a pictorial representation of what I mentioned, that historically they have, like, over a 20-year period, the sector has outperformed Nifty, so by 300 bips. But if you see the last 3 years, from 22 to 24, it has underperformed underperformed the Nifty index. So, and this is the first year where it has performed, like there has been outperformance, and we have seen that, this once it starts outperforming, it continues, the momentum continues, and we're also betting on that, that this is a year of inflection, and hence continue to be invested in the sector. So I'm coming to, okay, we spoke about the broad sector and what makes investing in the sector appealing, and hence why UTI, the Banking and Financial Services Fund. So as you can see, like, there are clearly structural drivers, and as well as the low penetration argument that holds for many segments within the space. And we as a fund try to take exposure to these non-lending segments as well, like insurance and capital markets. The benchmark is pretty lending heavy, so we have exposure to, I think, close to 15 to 20% in this non-lending space over a period of time. And as well as the second bet covers the beyond large cap argument, that in the diversified financials, the exposure to large cap banks is pretty high. The sector fund, like us, gives us significant exposure to mid cap and small cap, the niche opportunities that where we are bullish on. So I think that's how I would put it, and it's a bottom up portfolio with significant overweights on the smaller and mid cap names where we have strong conviction, that's what's visible in terms of our active weights that you can see, and I think that's what I would say about the portfolio. And over a longer period of time, I think over 3-year and 5-year period, the fund has outperformed the benchmark. I think that gives us the confidence, given where it is in terms of both fundamentally and also from valuation point of view. It's a good place to be in, and I think that it aligns with the whole large cap bias as well, in terms of what Vetri was also mentioning. So I would leave it at that, and we can open the floor to questions. Yeah.
Thank you, Preeti, and thank you, Vetri, for sharing your insights and updates. We can begin with the questions now. Vetri, my first question is to you. In your recent monthly commentary, you mentioned that US regime change last November is not merely a change in political power. It is a fundamental reset of their geopolitical and economic approach, which has both immediate and longer-term ramifications for the US and rest of the world. This fundamental reset of the world brings forth both opportunities and challenges. I would like to ask, what are these challenges and opportunities for India in the current context of tariffs and trade war?
Sure. So, very quickly, one could spend a whole day discussing the regime change, but if I were to sum it up in 4 different dimensions, the first is, I think, geopolitical. The US has been what is now referred to, we have been in a unipolar moment for almost 35 years, where there has been only one superpower. I think that one superpower is now worried about the emergence of a second superpower. And one of the things that they now are articulating very clearly is that they do not wish to have the role of being the global policeman, which has meant that they have taken up a disproportionate part of global defense spending. So this is something that they clearly want to pivot away from. It could also be because they now want to channel their military expenditure towards dealing with who they think is the bigger threat, as compared to where that spending has been oriented, which is Western Europe and the NATO alliance for the past 30 years. The second part is tariffs, where the argument is very clear. They are not happy with the trade deficits that they are running. But I would say this is a slightly biased view of the world, because remember, when we look at trade, we should look at both goods and services. The US runs the biggest services surplus in the world. They are also running the biggest trade deficit in goods vis-a-vis the rest of the world. So it's important to look at the consolidated number, but they are looking only at the goods number. They are looking at it as a loss to the economy. There's no point going into the economic arguments about it. This is their belief. Secondly, they believe that this trade deficit, which has arisen as a result of unfair trading decisions taken by other countries, has led to a hollowing out of manufacturing jobs in the US. So they have two targets: correct the trade balance, bring back jobs to the US, make sure that they have supply chain resilience in terms of national security. They don't want to be dependent on other countries for goods that they consider to be important to them because of security reasons. The fourth is fiscal. The US fiscal deficit, we've talked about this in earlier equity market insights, running at about 7% of GDP. They want to bring this down. Some of this is being done through cost cuts, which is what Doge is all about, but equally maybe trying to rein in the spending on account of military that they have got commitments to NATO. And of course, the way they are describing the tariffs at some point of time, it sounds like this is a tax revenue which can also help bring down their internal deficit. So it's about a more disciplined fiscal approach and tighter fiscal. I would say that is a good thing in its objective, though the means can be debated. Finally, monetary, they do want to see lower interest rates. And this is not only because they are now a debtor nation, but also, the fact that they believe their middle class constituencies have more debt than they have stock market ownership. And therefore, they would like to see, interest rates lower. Why does this mean opportunities and challenges for all countries, including in India? All these elements that I described eventually have an impact on every country in the world, because this has been at the heart of US policy for almost 35 years, some would say 80 years in the post-World War II environment. So it brings opportunities because India's relationship with the US now is much stronger than what it was at any point in time. So there is an opportunity for us to build on that. But there is also an opportunity for us to accept this challenge for what it is and perhaps focus on making our economy more competitive, reducing red tape, attracting more FDI, because what we really have, in my opinion, is two very critical attributes. The demographics of India remain attractive, abundant labor force. And remember, as the fifth largest economy, most likely the third largest economy in about 3 years' time, it's also a very attractive market for companies who want to come in and manufacture to supply to this domestic economy. So to my mind, this is also a great opportunity to figure out how can we attract more FDI, how do we deregulate, how do we bring our tariffs down, because eventually companies that are competitive will find global markets for their products. And that is why I think this is a big opportunity for India. And it comes at an opportune moment where today our fiscal is in very good shape. Corporate balance sheets are healthy and bank balance sheets are also healthy. So which is why I think it's both a challenge and an opportunity for India.
Unmute.
Yeah. Thank you, Vetri. Again, a follow-up question here. So in the current context, how do you see US policy towards dollar and how do you see impact on gold?
So the US thought process on dollar, I must say, is not very clear, because at one point they continue to insist that they want the dollar to be the reserve currency for the world. But equally, they are saying that the cost of being the reserve currency, which means that effectively, because the reserve currency is nothing but a mirror image of the trade deficit that they run. You can be a reserve currency on the world only if you are willing to supply dollars in unlimited quantities. One could argue that the biggest export that the US does is not of a goods, but of their own currency, which the whole world wants to own that currency. So the minute you think of the dollar as a tradable good, it is actually the most desirable commodity in the whole world for everybody. And that is why their, privilege of being the world's reserve currency is allied as a mirror image to the fact that they run the world's largest trade account, goods account deficit, or even on an integrated basis, the largest deficit. So if you want to reduce the deficit, you have to forego your role as the reserve currency of the world. But here I see a dichotomy, because sometimes they argue for we don't want the privilege, and then at other times they are arguing that we would like to see the trade deficit change. So I think this is one part of their policy which is not very clear how they will go. But safe to say, if you reduce global trade, the need for the dollar to be the gateway currency for all international trade will also come down. And sooner or later, necessity is the mother of invention. And sooner or later, countries will figure out how do we bypass the dollar to do trade, if this is what it would imply in terms of the US not willing to run trade deficits and therefore supply its currency in unlimited quantities. So I think this will change. Necessity is the mother of invention. Hard to describe how it will change, but I think it will change if this is what the US wishes for it to happen.
Sure. Preeti, coming to you. RBI has cut rates by 50 bips cumulative. What is the impact of rate cuts you see on the lending financials?
Right. So I think it will have two opposing effects on let's say specifically banks. So one is obviously because this is a new regime where the loans are linked to repo rate. So on day one or max with the gap of a month or 3 months basis the reset of the loans. So the loans will get automatically repriced, especially the mortgage loans, retail loans. While the deposits wouldn't. So it will take time as the liquidity improves and they're able to cut the deposit rates. So there will be a lead lag of that impact, impacting on NIMs. But the rate cut will also, I think the benefit of lower rates is also that it will also improve the demand situation for loans. And I think that will be slightly longer. So, but in terms of the NIMs, they were already, some of the private banks were sitting at record high or lifetime high margins. So they do have that buffer to let go of some of the margins and still deliver good growth and on earnings or let's say over the next 2 year period of time, 2 year period. And on specifically on NBFCs, it will be a sentimentally positive. And over a year or two, they will also benefit because they do raise funds or basically borrow funds from banks as they pass on the benefit through MCLR, which can take a year or 6 months to 1 year. So they will also see their cost of funds go down while their fixed asset side book might not reprice immediately. So they will have a positive benefit on NIM, and hence in the short term, NIMs will be expanding for NBFCs, where that will be contracting for banks.
Sure, Preeti. The next question is to you. What is your view on the asset quality in retail lending portfolios?
Right. So if you followed in the last 1 year, so there has been a lot of noise, and rightfully so, on some of the segments on which even there were some RBI restrictions which came in, specifically on MFI. Before MFI, it was unsecured loans, the personal loans. So wherein they raised risk weight assets for this segment, and eventually the MFI asset quality crisis also played out. So I think over this last 1.5 year, we have seen many of this excesses go out of the system. I think we are in a comfortable place where we can actually see growth come back after the slowdown that we have seen for 1 year, and the stress is peaking out even for a sector like MFI. While we might see impact in PNL over the next 2 quarters, the stress is already peaking out. So I think that's a positive sign, and with the rate cuts happening as well, so that should definitely provide a fillip to the loan demand.
Thank you. Vetri, my question is to you. With the earnings season just about to kick in, what is your overall expectations? Because just what we are seeing in Q3, this time with so much of news flow around, so much of uncertainty, do you believe that it may actually lead to some more further rate cuts, some more further cuts into the earning expectations, not just for Q4, which could also trickle down in FY26?
Yeah, my sense is that this time the earnings numbers will be a bit of a sideshow. I think particularly in the sectors and companies which are impacted by global growth, and particularly what is happening in the US in terms of consumer and business sentiment, there will be a lot more concern about what they are saying. So I would not worry so much about whether the companies hit their earnings numbers for Q4, which is what they are going to report. But what will perhaps move the market more will be their commentary about what they think the impact might be for FY26. So I think the focus will be more on that. And again, headline numbers are one thing. This time around, I would expect a lot more volatility around individual company earnings being reset, because this is what we mean by idiosyncratic risk. Which is another reason why I would always say, as an investor, your best protection against idiosyncratic risk is a diversified portfolio. That is why a diversified portfolio is key to remaining invested in the markets over long periods of time, benefiting from the compounding which happens in N, which is number of years, rather than worrying about what will be my R every year. So, I just want to bring that thought process back, that don't worry so much about the individual company volatility. We should be more focused on the aggregate.
Sure. Thanks, Vetri. Preeti, while you have explained what is your investment strategy, but in the current context, what is your approach to portfolio construction in current environment? Are you leaning towards large cap, mid cap, or small cap? And which segment of BFSI you are preferring right now?
So, as I mentioned, it's a bottom-up portfolio. So we are quite, like, if you see the top active holding, it is a small cap. While when you see at a very broad at index level, you would see that mid cap and small caps continue to be expensive. So because we are taking a bottom-up approach, and where we are finding value and also the visibility in earnings going forward, and comfort on asset quality, especially because these are lending names. So it's an outcome. The exposure on this large, mid, and small, it's an outcome or the byproduct of the portfolio construction that goes into, and it currently stands around roughly 75-25%. So 75% exposure is to large cap, and 25% is in small and mid cap. And in terms of segments where we are currently positive, I think to me, like I said, the affordable housing space looks interesting, given that it's still very small in size and in base, and hence they're able to deliver 30 to anything anywhere between 25 to 30% plus growth rates, which is probably one of the highest in the lending space, and with a lot of comfort on asset quality. That's one. Two is insurance. After a lot of pressure on, especially coming in from regulations, I think we see those regulatory headwinds that are behind us, and they're also trading at multi-year low valuations. So that also gives us comfort. And of course, we are positive on the banks. That's a very overarching theme on the private banks, and as well as the lending names, which are coming out of this, the small hiccup that we had in terms of the asset quality on unsecured loans over the last one and a half year. I think that's how I would put it. Yeah.
Sure. Preeti, our viewers has appreciated the way you have explained the fund strategy. And we have a question here. No, some banks had engaged into risky derivative trades. So what are the risk measures you take in such kind of scenarios?
Sorry, what is the risk?
Measures you take to avoid such scenarios.
Right. Thank you for this question. So if you see, the banks are a complex, companies, right? So I think they deal with a lot of these products, which it doesn't come to light until actually something goes wrong, like we have seen in this current case. So historically, I think the track record gives us the comfort, how over a period of time banks have managed, or navigated some of the crisis situation, gives us comfort on how the risk metrics as well. So some of these, like the case in question, so it comes out of the blue. So then we actually try to manage that with the positioning of such banks in the size. So it is very difficult. It'll be very a smaller position, because we do not have that comfort, or we have seen such cases happen even in the past. So I think the risk, the size positioning is a key solution in a way, how do you manage the risk in the portfolio, because there is no way to predict some of these things, right? And we believe that this is one-off case, and it was an accounting lapse in this specific case, and the bank, with the changes that are happening in the management, it should tide over this phase. So I think that's how I would put it. I think size positioning is the way to go forward.
Yeah, just to add to that, Sonal, some risk cannot be avoided 100%. If you are invested in the market, you are exposed to some level of risk. All you can do is you can mitigate it, you can manage it better. And I think what Preeti talk about is, a sensible set of measures to sort of manage that risk better. But we should be clear, you can never avoid idiosyncratic risk in the stock market. It can often detract from your returns, but it is those same idiosyncratic risks where some businesses outperform, which adds to the risk. So if you want something, you have to accept it in equal measure. What you have to do is try and ring fence those risks and manage them better. And that is what we try to do.
Sure. Thanks, Vetri. Thanks, Preeti. My last question, considering the time, Vetri, amid rising global uncertainties, as also highlighted by RBI and you in your speech, continued FII outflows and concerns around tariffs and global trade wars, what should be the approach for equity investors? How should investors position themselves in today's volatile environment?
Right. So I think simple answer to that is that the world's problems are not your problems, right? The world will figure out what it wants to do. Companies are better placed to figure out how to navigate that environment. We should learn to focus on what is within our domain, right? We know what our financial goals are. We know what our asset allocation is. And if you are a self-directed investor or you're working with an advisor, you have some sense of the valuation perspective as well. So I would say focus on what is in your domain, which is your asset allocation and your financial goals. Focus on what is in your domain, which is, as I said, when you think about the interest for compounding, right? It is 1 plus R raised to the power N, correct? Into the amount that you've invested. The magic lies in N, which is the number of years you are able to remain invested, not in, being in the best performing R every year. So those are the factors that you must manage. Think about it from a long-term basis, which is the benefit of N. Think about it from an asset allocation basis, which is aligned with your financial goals. And of course, today we spent a lot of time talking about our equity valuation index. It is in the increased equity allocation zone. So that is a valuation benchmark that we are giving you. You may have your own preferred valuation benchmark. But my suggestion to investors would be driven by things that you understand, which are in your domain. Don't make the world's problems your problems in terms of understanding how to, manage your portfolio or to achieve your financial goals. So stay the course. If I were to sum it up, I would say just stay the course.
Sure. Thank you. Thank you very much. On behalf of UTI Mutual Fund, I extend our sincere gratitude to all our viewers. We appreciate your active participation. We believe today's session provided you with the enriching insights on equity markets and how you can navigate this volatility with confidence. We also believe you have a fair understanding of the investment strategy and philosophy of UTI Banking and Financial Services Fund. Please share your feedback on the link provided. Special thanks to Vetri and Preeti for sharing invaluable insights and addressing the questions. Thank you and have a great day.
Thank you. Thank you, everyone.
Thank you, Sonal. Thank you, everybody.
Thank you so much.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.